Hello and welcome to this video where we will discuss the concept of clubbing of income. Clubbing of income happens in certain cases. What does that mean? The income seemingly might not belong to me, but for tax purposes it will still be treated as my income. Now, why would this happen so? An income which is not seemingly belonging to me, why would tax department insist on considering that my income? Let's look at cases one by one. First case, there is a transfer of income without transfer of asset. Example of this, let us say I have a property, I own a property and I tell my tenant that look, don't pay any rent to me. The rent that which you are supposed to pay to me, pay it to my parents. Now what has happened? Whom does the property belong to? The property belongs to me, but the rent is being paid to my parents. It is as good as me taking the rent for my property and giving it to my parents. I might be doing this because maybe that my parents are in a lesser tax liability than what I am in. But the rule on this is very clear. If I really want that my parents should get this income from tax perspective and not me, I will have to transfer the asset to my parents. Just transfer of income does not serve my purpose. However, there are certain cases where even transfer of asset does not serve my purpose. For example, if you are going to transfer an asset to your spouse, you have a property, let's say you transfer to the spouse. Whatever rental income he or she would make out of it would still be considered as your income. Same with minor children. However, for minor children, there exists a exemption of rupees 1500 per child for maximum of 2 children. Moreover, in minor children, it is also important to note that the income is always clubbed in the hands of the parent whose income is higher. It doesn't matter who is making the investment. Either of the parent could make investment or somebody else could be making the investment. For example, grandparents could be making, maybe the child has received gifts from aunties, uncles, etc. That doesn't matter. Ultimately, if the gift or if the money is being invested in the name of a minor child, the tax burden or the tax liability of that will be fall on the higher earning parent. Daughter-in-law. If a father-in-law or a mother-in-law transfers similar property or asset to daughter-in-law, income generated by that asset, even though transferred, will still be continued to be considered as income of father-in-law or mother-in-law. Please note, it does not apply to sons. So you could transfer your property to major son and the income being generated will be considered as son's income, not your income. And same for daughter. This applicable provisions are only for spouse, minor children, and daughter-in-law. There's one more item which actually is not a person, but the same provisions apply. If you are going to transfer your asset to your HUF, any income being generated by HUF from that asset again will be considered as your personal income and not the HUF income. Another instance where clubbing would happen is when a revocable transfer is done. What is a revocable transfer? Transfer which can be cancelled anytime in lifetime of the transferor if he wishes to do so. So I am transferring a property to you, but I also have a right to get my property back anytime within my lifespan. In such a case, the income earned by the asset will still not be the transferee's income, it will still be the transferor's income because I have not completely relinquished all rights on the asset. I still hold certain rights, the right to take back the asset whenever I want it. And hence, If you actually want that your income should not be clubbed, then you have no option but to do a irrevocable transfer. And the last instance where clubbing happens is income of spouse from a concern where one has substantial interest is. Now, what do we mean by concern where one has substantial interest? Concern could be any organization. Substantial interest could be defined as somebody having 20% ownership stake or 20% stake in profit. So, I might own 20% of an organization, or I may not actually own, but my compensation involves at least 20% of the profit of the organization. Now, more may be possible, that's not a problem, but 20% and more is defined as substantial interest. This provision, however, will not be applicable in a certain circumstance. If a spouse has technical qualification related to the business, then such clubbing will not happen. Example, if you are into financial planning, a simple 1 month diploma will do the job. If your spouse, however, is a cardiologist, it will not help. We are not talking of the level of education, we are talking about a relevant technical qualification in the given field of business. So, these are the instances where incomes may be clubbed even when they seemingly don't belong to you. That's all about clubbing of income. Thank you.